Good morning, everyone, and thank you very much for joining me. This is the morning market review. It is Wednesday. It is the 12th of April, and my name is Russell Shaw. I'm a senior market specialist at FXCM. My email address rshaw@fxcm.com. If anybody needs to contact me, that's the email address to use. Just going to bring up a high risk investment warning. Can I just confirm that everybody can see the screen, hear me, and see me on camera? All right, let's just bring up the market commentaries disclaimer. And just finally, we'll take a look at Market Scope, Trading View, and the CME group. Just to bring up the CME group. Hey, Demir, morning to you. Hey, Anna. Nice to have you on the webinar. Thanks for everyone for joining this morning. Much appreciated. I just want to show you the next Fed meetings on the 3rd of May. At the moment, it's around about 70% for a 25 basis point hike. This is going to be interesting. We should take a look at this tomorrow because at 1:30 UK, 2:30 ZA, we're going to get the CPI numbers, and we want to take a look and see if there's moderation in the inflation rate, and if there's inflation in the if there's moderation in the inflation rate, we want to see if there is going to be a change in the probability of a rate hike. Now, the chart that I'm looking at in terms of the core inflation rate, well, here's the core inflation rate, and then I've put a 12-month rate of change, and really to see how sticky the inflation is. Let's just take this out. Just to see how sticky the inflation is, how does it react according to the zero? Let's just taking it. So I'm just looking at the interaction of the rate of change to zero. It's got to stay under zero to show deceleration. Okay, so if we just go back, every time we see the core inflation rate coming down, the rate of change or the acceleration is showing deceleration. So we need to see the rate of change maintain under zero. Effectively, where the target is, now this is not the Fed's preferred target. The Fed's preferred target is the PCE, the core PCE, but we want to kind of see this move towards 2%. And the only way this is going to move towards 2% is if we stay under zero in terms of the rate of change. In other words, the rate of change of the core inflation rate year on year, which in itself is a rate of change. Take a look here, guys. I just want to show you, here was a nice deceleration, and then you can see that it loses slope, doesn't it? It loses steepness. There's the stickiness starting to come in. So we wanted to see if the gradient of the core inflation comes down, and we want to see if we can get deeper into the deceleration here. Target 2%. So that's basically what we're looking for today, and I think that the print is going to have an effect on the probabilities here, which we'll check tomorrow. If it comes in higher than expected, then you'll see this jump towards 100%. And not only will you see it, you might start seeing 525 to 550 coming in, some bets coming in for 525 to 550. In other words, a 50 basis point hike. I don't think that's on the cards. My feeling is that we are showing signs of deceleration here, and I think that there will be a moderation in the core inflation rate. I did take a look at the median inflation. It hasn't been updated from its last print, so we're not going to look at that today. I'll carry on keeping an eye on it and see when it gets updated. We'll take a look at the median. The median for me is my preferred measure of stickiness. So, but on TradingView it hasn't updated yet, so we won't take a look at that. You can take what we mentioned yesterday was the 2-year yield. The 2-year yield is a good proxy for monetary policy, and there is a certain indecisiveness here, or indecision, uncertainty, however you want to refer to it, in that we've got an inside week. And this is another chart for us to keep an eye on tomorrow. So we're going to revisit the CME to see what the probabilities are in terms of rate hikes. And we want to see if we still have an uncertain 2-year yield. Why do we want to take a look at the 2-year yield? Because the 2-year yield, in effect, is a proxy for Fed monetary policy. And the idea here is that the uncertainty in the 2-year is telling us that the market is fairly uncertain with the way the data is going to print. We saw a fairly robust jobs data on Friday. If we see robust inflation data, then we'll see the start moving up. If we see the moderation, it's going to be interesting to see how the fixed income market treats this. Let's just let's take this out, and let's just do one more thing here. Let's just add in the Fed funds rate, which we've looked at it before, but I think it's worth just taking a look at it again. So we'll look at the Fed funds rate as an overview here. And you can see that the 2-year yield, which is the candlestick chart, is under the line chart. The line chart, this orange chart, which I'm going to change up to black, make it a bit thicker. So every time the 2-year yield drops below the Fed funds rate, it does seem to suggest that we're near the top of the cycle of that Fed funds rate. And if we're at the top of the cycle of that Fed funds rate, I would expect to see this carry on moving in that southeasterly direction, pulling the Fed funds rate with it. Now, what I expect and what will happen are two different things, right? It really depends. It really depends on the print. So the CPI print, just remember, 130 today UK, 230 ZA. All right. So that's what I wanted to show you on the inflation front. I just want to take a look at the pound and the euro, and I want to take a look at it in terms of the growth model and the value model. So let's have it just revise the growth and the value model. Okay, so the growth model is where you've got some sort of consolidation, breakout, consolidation, breakout, consolidation, and that's typically how growth instruments tend to move. And then if you've got a value model will be a little bit more digital. It will go from consolidation to say mark down, to consolidation, to mark up, to consolidation, to mark down, and then back to consolidation. So those are the two different models, and the value is to be found here. Okay, that's where the value is. So with that all said and done, Let's just take a look at cable, because the cable chart I think is quite fascinating, and we'll come back to euro in a moment. Just want to bring up just give me a moment. The systems, there we go. All right, markup, consolidation. Okay, let's just make it like this. Okay. So now what we're looking for effectively is a breakup if it's going to follow the growth model, a breakdown if it's going to follow the value model. Now, let's just discuss, what do we think is going to happen here? Is it going to break up or is it going to break down? We obviously don't know with any sort of certainty, but what I would suggest is if there is a moderation, okay, if there's a moderation in the inflation, we want to go back to the CME FedWatch tool. We want to see if this reduces, okay, if the probability reduces for 25. I think we will get 25, but we'll just watch this probability. It really depends on the print. This inflation print, I think, is very, very important. We also get the FOMC minutes today, by the way, later in the evening, and we can see what the expectations for inflation is on the Fed side. But the idea here is we want to see if this reduces. If this reduces, then what we can do is we can take a look at the Fed 2-year yield relative to the British 2-year, right? So we just look at the spread between these two. So you've got to put the minus sign at the right place. There we go, that's better. And let's get rid of this guy. And what we can see is trough, peak, and what we're looking at is we're looking at the relative hawkishness between the Bank of England and the Fed. And I think that there's going to be more of an influence from the Fed backing off. And why do I say backing off? Because we've seen that 2-year yield is dropping below the Fed funds rate, which often suggests the apex of the rate hiking cycle. And we've seen that there is a deceleration in the inflation rate. We're going to have to re-examine all of this again tomorrow, but if that deceleration, then the Fed probably backs off. Well, then we've got 2-year yields, a 2-year spread in favor of British gilts, right? So you can see that the 2-year here does seem to suggest a weakening in the Fed relative. Take a look if we look at it in terms of not monetary policy but investment policy, and we take a look at it on a 10-year basis. Again, what do we see here? Trough, peak, higher trough, higher peak. So what does this suggest? We go back to market scope, and to me it suggests possible breakout to the upside. So we can look at it, and just to be clear, I'm going to put a question mark there because we don't predict, okay, we analyze. So we just want to see if that's the way it's going to go. Now, if we take a look at the US dollar, the US dollar has got this topping pattern in left shoulder, head, possible right shoulder. I've got a question mark there. Again, I think it's very much going to depend on how sticky the core inflation is, and so it's quite a nerve-wracking release that we're going to have this afternoon. So we're just going to have to watch that very, very carefully. But we want to see if we get a head and shoulders pattern completion here. We can do a similar analysis with the euro, by the way. We bring up the euro US dollar. And 110 all of a sudden is looking very doable. 110 is looking very doable. And assuming 110 is doable, then 115 for the second half of the year, I suggest is something that we keep an eye on. The RSI is above 50, but let's go back to the spreads. So we'll go back to the spreads, and instead of taking a look at the British, let's take a look at the German, right? And you can see the spread is moving heavily in favor of euro on an investment basis. Let's take a look at it in terms of a monetary policy basis. So we'll go to the 02, and you can see exactly the same thing. So 110 on the euro, I think, is certainly a target. What's the big X factor? It's the CPR. CPR coming out today. I want to just repeat it: 130 UK, 230 ZA. So you can see that the Forex markets are looking very interesting indeed, and it really depends on how quickly the Fed backs off. I think the Fed here is the active player, and it's all about how quickly the Fed backs off. All right, that's really what I had in my notes for today. If there's any questions, go ahead and type those in. What I would suggest is that everyone exercise caution when the CPR gets released. It is a really important number, especially after the robust jobs number. So we're going to keep an eye on that. And then after that, keep an eye on the FOMC minutes. Those minutes are going to be very instructive indeed. With that all said and done, there's no comments coming in. So let's wrap up over here. I want to thank everyone for joining me today. Have a good day ahead, a good evening ahead, and we will do it all again tomorrow when we've got a little bit more information. Tomorrow, we will also do the crypto minute. Thanks very much, guys.